How do you know how much to put down when buying a home? Let's get into it. So you're looking to buy a home and you want to know how much money to put down. Could be a first time home, second time home, or a forever home. You're looking to buy a home and there's a lot of different questions on how much to put down. Should I do a large down payment, or should I do a low down payment? A lot comes with a lot of different questions, a lot of different reasoning and why you're looking to buy the home. So how much home can you afford is going to dictate how much down payment you need, because they're going to times the purchase price of the home by the percentage that you need, whether it be 3.5%, 5%, 10%, whatever it is, 20%. So do I really need to put 20% down? Because that's a big thing that goes on in the lending industry is buyers are being told, you should probably put 20% down or more. The reason for the 20% ideal target there is because with 20% down, you don't have to pay PMI. PMI is private mortgage insurance. So when you're buying a VA home or FHA home, then you do PMI if you're putting less than 20% down. But the same thing also applies for the conventional loan. It just is called something different, right? Different names. But the fact is, if you're putting less than 20% down, you have to pay a monthly PMI, and each loan is different. FHA will have their own rules, VA will have their own rules, and conventional is going to have their own rules. So we're not going to get too much into that. What we're going to get into, if you can't afford to put 20% down, it may make sense to put less than 20% down as long as you can afford it. Maybe doing a USDA loan, which requires no money down. Maybe doing a VA loan, which also requires no money down. Maybe doing an FHA. FHA has a minimum requirement of 3.5% down. And on a conventional loan, you could also do as low as 3.5% down. The only difference would be the PMI. Now, if you have a low interest rate, the PMI might not be a big factor. But if you have a higher interest rate and you're going to have the PMI on top of that, that might be a factor. So when are some of the times that you should indeed go ahead and put the 20% down? So let's compare putting the 20% down versus not putting the 20% down. Let's do putting the 20% down first. If you're putting the 20% down, then one of the reasons that you may want to do that is you want to have a lower monthly mortgage payment. So if you have a high down payment, then obviously your mortgage payment would be lowered. And then you got to figure out the maths. So you want to know, if I was to put 10% versus 20% down, what would that monthly payment be like? And if I'm doing 10%, what would be the PMI? Does the maths make sense? Maybe it comes out to $100 less per month, maybe $200 less per month. So it depends. And also you're going to be watching your debt to income ratio as well. Another thing is you won't have to pay PMI. So if you put 20% down, there's no PMI, 20% or more down, lower your monthly payment, no PMI, that could be a good reason. Another one is maybe you're buying your forever home and you do not want to have a high monthly payment because maybe you're retiring and you want to have very low or little mortgage. So that would make a lot of sense to put 20% or more down for sure. Maybe you're retiring, as I just mentioned, and you want to put as much down as possible so that maybe down the road, if you had to do a reverse mortgage, you'd have enough equity in the property to do so. So that may be a reason why you do that. Maybe you want to pay off the home quickly. Maybe you're like, you know what, I'm going to buy this home. I don't want to have to pay a mortgage payment for 30 years. I want to pay it off as quickly as possible. So I am going to go ahead and put 20% or more down, making my mortgage payment low. And then I could also work towards paying it off. Maybe putting a higher down payment could also mean you're going to have a lower interest rate. So the bank might say if you put 10% down, it's this interest rate. You put 20% or more down, the interest rate will go down. So that would make a lot of sense for you to put 20% down. Now, when does it not make sense to put 20% down? Let's say we are low on funds, like we don't have a lot of money, we want to buy a home, but we don't have a lot of cash saved up, so we got to do a lower down payment. So if we're going to do a lower down payment, we may not want to go too high on the purchase price, because of course the higher the purchase price is, the more your down payment, irrespective of what the percentage is. So if you're working with a lower down payment, then you want to do a less expensive home, right?
Need to buy or sell fast? Make one call, that's all. And put our 23 years of experience to work for you. Gift Group Sells Homes is the way to go. Call for 07-791-4713.
So maybe you don't have enough money, just want a lower down payment. Maybe you're paying a lot of money in rent. Maybe your rent cost is really high and you just want to buy a using you want to use the money you're using to pay rent to buy the home, so you're going to have a lower down payment, which is fine. You could go ahead and do that. Maybe the property is in a USDA zoned area and you could buy the property with no money down. So that would make a lot of sense as long as the mortgage payment is in your debt to income ratio situation right there. Okay. Also, FHA is a government program that helps people to have it influences home ownership. So it wants more and more people to have a home. So FHA will allow you to buy a home with 3.5% down, and they also will allow you to buy a home with a lower credit score than most conventional loans. So FHA is very lenient. Yes, they're going to have a higher interest rate, but they're going to be able to put you in a home with 3.5% down. Yes, you're going to have PMI, but they're also more lenient on your credit score. So if your credit score wasn't that high and you really want to buy a home and you have some money to put down, FHA may not be a bad road to take. I definitely like FHA loans. Another one could be maybe you have money in a 401k or in some kind of retirement plan, but you can't pull all that money out without penalty. So maybe it might make sense just to use the cash you have and do a low down payment. And later on, as the retirement mature, you might be able to pull that and put that towards your principal, but you'd have already owned the home. Or maybe you have savings or dividends or some kind of investment going on the stock market, but you don't want to pull all that money out because you may have to pay a penalty, or you just want to ride the wave. Maybe you're making more return on the other investment, so you decide to put a lower amount of money down and buying a home. Or maybe you're buying an investment property, and a lot of time with investment property, you got to put 20% or more down. But when you're buying an investment property that's also going to be your primary resident, you're allowed to put, a lower down payment because it's an investment property, but it's also your primary resident. Like if you're buying a 2-family home or a 3-family home or a 4-family home, up to a 4-family, if you're going to be living there and renting out the other units, then you're going to be buying it as a primary residence, providing that would be your primary resident, of course. And then you could put a lower down payment and it wouldn't really matter because you're going to be renting units out. So the tenants that you're renting to is going to help you to pay your mortgage. So even if you have the bank is going to consider the other rents that you're going to be collecting from the other units. So then your debt to income ratio would be better because you have more income coming in from the units that you would be renting, or maybe they're already rented, so the bank would want to see the lease. So at that point, you probably wouldn't want to put a high down. You don't really have to put a high down payment down because you have other income coming in from the rent to help you with that. Hope that makes sense. So there are pros and cons of putting a high down payment or a low down payment. I would say stick with whatever budget you're working with, what makes sense for you and your family. On a primary resident, you probably have enough money to put down, but maybe you want to save some money for the rainy day or for an emergency fund, or you want to hold some money back for improvements. Maybe you want to do some cosmetic work when you purchase the property. Maybe you want to put a pool in. So going in with a lower down payment doesn't necessarily mean it's a bad idea. As long as the debt to income ratio is at par, and as long as you're able to afford the monthly payment with or without PMI, then you're fine. Now, FHA has changed their rules. So once upon a time, for most conventional loans, that still occurs now, but this used to also be with FHA, but they have changed their rules. So with conventional loans, if you put less than 20% down, once the property builds itself in appreciation, so it appreciates in value, and it's worth up to, you have 20% of equity in the property, the bank will allow you to refinance out of the PMI loan, right? So out of the private mortgage, the private insurance, private mortgage, it's so much different names it's called, right? So you wouldn't have to pay the PMI anymore or the private mortgage insurance anymore once you have 20% of equity. So let's pretend you bought the home with 5% down, and let's say 3 years from now you have 20% of equity. Conventional bank will allow you to refinance and get rid of the PMI because you have enough. The 20% down payment is represented in the equity you have in the property, right? So that may be a great idea. FHA used to do it. No, they don't do it. They have all different stipulations on that, so we're not going to really touch on that. But just know if you have a conventional mortgage and you put less than 20% down, you would be able to refinance once the property. Some banks give, if you have 20% in equity, some banks say if you have 30%, some banks say if you have 40%. So once you have between 20 to 40% of equity on the property and you bought it with less than 20% down and you're paying PMI, you can refinance out of it. Okay, so that's some of the reasons why you would want to do that. But in terms of down payment, there's some loans you need no down payment. There's some loans you need a little bit of down payment. And maybe it's your second or third home and you're selling a home to buy another home and you want to pull all the money you're making from that home into the next home. That's a fantastic idea. So there's different ways of doing it. There's no hard or fast way. Each situation is going to depend upon what is your current situation. I hope that helps, guys. I'll see you in the next video.
Need to buy or sell fast? Make one call, that's all. And put our 23 years of experience to work for you. Gift Group Sells Homes is the way to go. Call for 07 791 4713.